So today the market is mixed. There are several big names that are moving downwards and some are moving upwards. AMD is having a big day today. Some of the other semis are moving as well. Some of the big tech names like Microsoft, Google are going down. Meta is continuing to go down. Apple and Nvidia pretty much steady and flat. So there's a big mix in the market today. And looking at my portfolio, the public long-term portfolio, you can see that there is a variation there as well, similarly to the overall market. But this is one of the reasons why I chose to invest in some non-AI plays. Look at Warrior Met Coal is up to $85 plus, and it is bucking the trend of all these other AI plays today. Tidewater is another non-AI play that's going down, but it had a huge uptick after their earnings 2 days ago. That was to be expected after such a strong move. Even the move in HCC was 23% up after earnings, and it's still continuing to gain strength, almost like a hedge against my AI plays, which are all down today. So you can see Meta is continuing to suffer here. Another $1,700 down. Google down $1,291. Amazon down $636. And PayPal, PayPal is being PayPal again and it's not moving at all. So there's two reasons I wanted to do this video is to go over, the overall portfolio, which I just did, a very quick look at what's happening in the markets today, and to show that investors should diversify their portfolios at least a little bit, not just AI names, but a few high quality, high compounding, and high growth non-AI names like HCC or Tidewater or any others that you do due diligence on, have strong moats that will withstand market pressures and sellers and will compound your wealth over time. The other reason is I wanted to go through Tidewater's earnings and financial highlights because they recently reported 2 days ago and they had a huge jump up in their stock. And now that stock is falling a little bit and giving back some of those gains today. So if you like this content, please like and subscribe, and let's get straight into it. So I wanted to start with PayPal, and PayPal is a very small percentage of my portfolio, but they continue to innovate and continue to deliver new things that could provide growth to the company. Their growth is super slow right now, and their earnings and revenue growth need to pick up for investors and analysts to re-rate this company to a higher multiple that it should be fairly valued at. But for right now, the market continues to discount this name. It jumped up after a little while and then came right back down into the 60s. So I noticed this on X today. And if you're not following me on X, please follow me on X. I post a lot there, a lot of content there, a lot of stock analysis there. So it's really a valuable tool for everyone, for investors. So I noticed that PayPal made this comment here. There's big news for UK shoppers. The relaunch of PayPal and PayPal Plus is here. Our first ever free rewards program. You can earn points almost every time you pay with PayPal. Stack rewards with other loyalty programs. 10x the points with the new PayPal debit card. And PayPal credit is now in store. So earn points online or on the high street. The first step in our £150 million UK investment. So they're really expanding in the UK. They're pushing their debit card really hard. You can see 10x the points. That beats a lot of credit cards and debit cards right now. They are able to stack rewards with other loyalty programs. They're really pushing this hard so they can gain a lot of traction, a lot of users on their PayPal system in the UK for UK shoppers. They're probably going to win a lot of market share because these are very excellent rewards and incentives to use PayPal in the UK. So if we click on this, you can see it's a very nice reward system. Welcome to the rewards revolution, PayPal Plus. And so they're showing this off in the UK. And if it does well, I'm sure it will expand to other areas in the world. Now, if we look at the metrics and financials for PayPal, you can see that it is undervalued. The PE ratio, trailing 12-month, is 13.49. It has a 1-year price target from analysts at $83.36. Another piece of news is that they're going to start paying out dividends. A small dividend. Right now, the dividend yield is going to be 0.83%. But with PayPal's free cash flow yield, they'll probably be able to sustain that and grow it if they can grow their revenue and earnings, I don't see them suspending this dividend anytime soon. They can manage this 56-cent per share dividend for a long time and grow it over time. But the real main thing with that is they're still continuing their stock buybacks. So they take their free cash flow yield and buy back $5-6 billion worth of stock every year. And with a market cap of $62.848 billion, that is a large portion, almost 10% of the company every year, if they were to focus all of that free cash flow onto stock buybacks. And that's insane. So their free cash flow yield will just continue to grow. Their outstanding number of shares will continue to decrease. And when those things happen, the stock EPS will be inflated because there's less shares outstanding, and their numbers are just going to look better and better and better. And so price will naturally just have to go up. Even if their earnings stay muted, the price is going to have to re-rate and go up because the shares outstanding is getting less and less and less. So it is basically becoming a stock cannibal. It's eating its own shares, eating the company back. Hopefully, PayPal won't have to rely on stock buybacks as the means to return investor capital. But I'm hoping that all of these initiatives that Alex Chriss has initiated last year, are going to grow the revenue and earnings substantially, or at least meaningfully, into the future. So they do have a lot of competition with Apple Pay, Cash App, Firm, Stripe, all of these other competitors. But they've been around for a while, and PayPal is still here, still posting huge free cash flow and still buying back their shares. So the management still feels confident in their business into the future. So I'm going to align myself with the management, astutely buying back shares when the price of the stock is well below its fair value. And I'm going to continue adding on to these shares as the stock price is super low. For my Google, Amazon, and Meta shares, my whole plan is to just keep the shares and continue to add on weakness. So if you look at the stock market, Google has been on tear past month or two, and they have gone up to over $290 per share. I was buying Google shares in the 140s and 150s. So I'm not going to be adding any Google shares at the moment. I feel comfortable with the 200 shares I have. They have YouTube, they have Waymo, they have GCP, they have their search, which is not being disrupted by ChatGPT like everybody thought back when the stock was $140, $150. So I feel very confident I can sleep easy owning 200 shares of Google, but I won't be adding any more just because it's so over my average cost that it's kind of ridiculous. I'm making a huge gain on those shares. My Amazon shares, similar, not as much upward momentum as Google, but still up from where I bought it, and I'm making a huge gain on that. They, similar to Google, they have so many things going for them. They're the first mover in the cloud space with AWS. They have one of the largest logistics networks and businesses. They have their huge e-commerce platform. They have so many other things. They have their Zooks, they have their robotics, and there's so many other things they're in that I sleep easy knowing that I own Google and Amazon. Meta has been criticized recently because they're overspending in AI, or seemingly overspending in AI. Like I've mentioned in previous videos, Meta's revenue primarily consists of advertising revenue. 97-98% of advertising revenue. And then the other is, wearables and other devices type revenue. And they've been losing money in Reality Lab segment, and for as long as I can tell. So Meta has been under the gun because they have been overspending in AI. They've been overspending in getting talent for AI for their super intelligence lab. You recently saw that Jan left Meta, and he was the chief AI scientist at Meta. So that was a huge blow to Meta's AI ambitions. But I mean, the way they're spending, they'll probably spend a lot of money to pick up more people, more talent that way. And Zuckerberg recently said that he is spending aggressively on AI, but he will see a return on that investment. And as long as they can keep spending and generating money from their other business segments, it should be fine. But investors are a little skeptical. They might see this as a 2022 moment, sort of. It's not that bad yet, but it's trending towards that type of scenario, and investors are a little skeptical. But they were able to right-size that ship in 2022, and then they did about a 10x after that. So I'm optimistic with Meta, and I will be buying the weakness in this company and the shares. My average cost is around 580, so once it gets close to that or below 580, I will be buying shares in Meta again in the public account. So that brings me to the main point of this video, which is Tidewater earnings, the Q3 earnings that they just reported. So I'm bringing up their investor presentation here for November. A lot of this information has been covered in my previous Tidewater video that you can find here, but let's go through what's new in Q3 of their results. So they are the largest offshore support vessel operator in the world. They have the strong international footprint. So you can see all these orange dots here all around. They have a huge presence in Americas. They have a huge presence in Europe and Africa and the Middle East. The vessels provide support to offshore E&P, subsea, offshore construction, and wind activities, including towing, anchor handling, and transportation of supplies and personnel, construction, and seafloor evaluation. Latest acquisition was about 37 vessels from Stolstad Offshore. So now they own 209 vessels, which is the largest OSV in the world, fleet in the world. Here is the breakdown of their OSV fleet. So I'll pick out the most important things from this slide presentation. One of the most important thing is they've been meticulously high grading their fleet. So what high grading means is that they are removing the vessels that are old or not purpose driven from their fleet. So their entire fleet is more efficient and purpose driven, purpose built for making money and increasing their day rates. So here you can see that they added 83 premier high-quality vessels to its fleet via M&A. That's their preferred method of adding vessels to their company, and also providing shareholder returns is by M&A. They did that via M&A over the last 3 years. So the legacy Tidewater had 108. So through these acquisitions, they got to 191 specific premier high-quality vessels. Look at their competitors and their ages of their competitors' fleets and Tidewater's fleets. So here's Tidewater as being the largest OSV provider in the world at 191. Their age is around a little under 14 years, I would say 13 years. And you can see how Tidewater is in the middle of the pack with all of these orange dots. So they're doing pretty well in terms of average age. Some of these, their next biggest competitor has an 18-year-old average age fleet, which is pretty old. So way older than Tidewater's. Now they have a blue chip customer base, so they do business with a lot of oil companies: Chevron, Eni, Oxy, ExxonMobil, Aker BP, Saudi Aramco, ConocoPhillips, Shell, BP, BHP. So they have a strong ability to generate revenue based on these big multi-billion-dollar companies that they're doing business with. Now here is some of the key things to look out for: day rate and gross margins through Q3 2025. So their day rates continue to improve, and they've been charging more and more in their day rates, which is the primary factor in how much revenue they bring in. And their gross margins overall have been increasing with a slight little dip here in the last bit, but overall you can see that the trend is up, and there's been significant improvement from. Now the market overview, you can see that offshore commitments by water depth, they are anticipating a huge increase in 2027. And this is one of the reasons why I'm so confident, or I feel so confident in Tidewater, because management is seeing a lot of offshore commitments coming through in 2027. It's a slight increase in 2026, so that should buoy and support share prices from 2025. It's not a decline, but look at this huge increase from 2026 to 2027. That's a huge increase in the offshore commitments, and it should increase the price of the shares of Tidewater immensely if that was to come to fruition. And they're saying, management is saying, global offshore investment is projected to accelerate through 2027. Utilization rates are getting higher and higher, and that is also something you want to see, because if they are not utilized, if the fleet is not utilized, then they are not making money. So you want to see as close to 100% utilization as possible. The new build economics considerations is why Tidewater does M&A instead of building all new vessels for their fleet. If you look at this, you can see that a new build cost around $65 million. Even assuming a day rate of $44,000 a day, which is not close to what they're making right now. They're making about around $22,000, $23,000 a day. Even at that high assumed day rate, with all of these other assumptions, dry docking costs of $2.6 million every 5 years, utilization percent at 90%, a weighted average cost of capital of 13%, and 20 years to earn cost of capital, so a 20-year lifespan for the vessels. Even with all of those, it would take 18 years at a $45,000 day rate to break even on that investment. It would take 20 years at $44,000, and it would take 24 years at a $43,000 day rate. So there's no point in building new vessels if it takes you 18 to 24 years to break even on that investment. And this is why Tidewater does M&A to grow their fleet and become the largest in the world. They don't have to pay these insane prices to build and wait 3 years to get their vessels. They can put these vessels into production and use immediately if they're already built and getting from a competitor or somebody else who was doing poorly. They can acquire these vessels and grow their business operations. Now you can see the shipyard capacity globally is going down as well. Global shipyard capacity down 57%. So even the builds are going to take longer and longer because these shipyards are declining at a fast pace relatively and continuing to decline because no one's trying to build these. So there's no need for them. And so demand is going way down, supply is going way down. So all in all, this is going into making Tidewater one of the only names in the OSV space. Here you can see OSV fleet attrition. Global OSVs have been declining approximately 40% are going to be contracting by approximately 40% over the next decade. So active OSV fleet attrition, vessels to age beyond 25 years. Of the vessels that are active right now, approximately 990 OSVs will age beyond 25 years over the next decade, or approximately 37% of the active fleet. So globally, there's going to be less shipyards, there's going to be less fleets that are able to do the work of OSVs, and basically Tidewater is in a perfect spot to acquire, do M&A, and combine all of those existing fleets that are still working. So let's go through their financials and their Q3. So revenues, they're anticipating, this is estimate, 2025 E is estimate, a little bit decline from 2024 just because of the tough nature of the business right now. And adjusted EBITDA also down 1% estimated, which is not really that bad. I think this will grow up like this over time with that huge potential in 2027. Gross debt and cash. So they recently consolidated their various debt into one unified debt vehicle, about $650 million in July. And they don't owe anything on that. The first payment of that is in 2030, in July 2030. So they right now are really good in terms of their debt. They don't owe any payments on it right now. And what I really want investors to pay attention to is look at the cash on hand. Since 2021, 149 million, 2022, 170, 2023, 276, 2024, 329, 2025, 431. It has been growing up and to the right. So they are gearing up for something major, and I'm thinking it's going to be some type of M&A that will grow their fleet, grow their revenues, grow their free cash flow, and eventually provide a large return on capital to investors, which is what I'm banking on. But not only that, look at from 2023 onwards, look at their net debt to EBITDA. It's going down, 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 which is great to see. It was 1.2x in 2023, it was 0.6x in 2024, and 0.4x in 2025. And management has stated that their goal is to keep that under 1 while still being able to do M&A and shareholder returns. Significant cash generation via day rate normalization. So this shows what their cash generation, their unlevered vessel level cash flow generation would be at different day rates. So right now we're right here, and they're just going to be able to, because of all the factors that I've mentioned, push higher day rates as they are become the only players in the game, really. So right now they're doing 417 unlevered vessel level cash flow with their day rates around 22 on average, 23,000. But look at the change if they change to an average of 24.3 thousand a day. It would double their unlevered vessel level cash flow to 835 million. And then it just continues from there. If they can push higher and higher day rates, their numbers explode. Their free cash flow will explode. And that will come back to investors in one form or another, either M&A or share buybacks or both. And management has stated that it's not a either or, it can be both. Now here's the slide talking about their debt capital structure overview. They did the refinancing in July. So now they have 650 million in senior unsecured notes that mature in 2030, so they don't have to pay until July 2030. And it's at 9.125%. Now they use the net proceeds together with cash on hand to repay in full the company's existing senior secured term loan, fund the redemption of the company's outstanding 8.5% senior secured bonds due 2026, and its outstanding 10.375% senior unsecured bonds due 2028. They basically consolidated everything, pushed it to 2030, and they're going to have so many M&A opportunities and so much free cash flow between now and then, they're going to be in a great spot come 2030. And they entered into a 250 million revolving credit facility, which is currently undrawn, and that gives them even more flexibility when it comes to M&A. So overall, I think Tidewater has delivered amazing results for Q3 2025. I think that's why their stock shot up after a little bit, because investors saw that and were like, wow, this is amazing. I like the things that they're doing. They consolidate their debts so they don't have to pay for them anytime soon. They are returning capital back to shareholders. They're keeping shareholders top of mind with their $500 million authorization for share buybacks from the board. They are actively thinking of M&A possibilities. I listened to the earnings call recently, and management, there was a question about what they're going to do with this increasing amount of cash on their balance sheets. And they did not say, but I think a strong hint was M&A, and they're looking at an M&A position right now to do. So I would not be surprised if in the recent next few months to year, they're going to announce their next major acquisition, which will grow their revenues, which will grow their free cash flow, which will grow their earnings. It will be all around good for investors at the end of the day over the long term. So my plan for Tidewater is to keep getting shares. I think that anything around 50, my average cost is $51. So anything around $50 or $51, I'm going to keep adding to this. I'm going to DCA into this name and try to grow and concentrate this position, because I think the long-term fundamentals, it's there for this company, and I'm very excited to add more to this position. So that's it, guys. If you like this content, please like and subscribe, and I'll see you guys in the next one.